It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're scoping out the leasing competition in the aviation arena. I'm here with Steve Trent, Citi Research Managing Director and Airlines Analyst. It's great to see you, Steve.
Same. Thank you for having me.
So we're going a little further afield today. Usually we talk to you about the airlines themselves. Today we're talking about the leasing companies, which is really interesting. Let's start with AirCap. Now, this stock's already done pretty well over the past year. It's up by more than 50%. And I have to admit, I didn't know much about it. So I did a little research. This is a huge company in this space. In part, it has grown through acquisition. So talk to us about why that is an advantage.
Yeah, absolutely. So I think you said it very well. You have 22,000 commercial jets in service worldwide today. And AerCap by itself, a fleet of 2,500. And that's ignoring the managed fleet. So when we think about its growth, it's grown organically and it's grown through acquisitions. You had the GECAS acquisition back in November of 2021. Several years before that, you had the ILFC acquisition. You had some more before that. And these acquisitions have been important in terms of the price point at which this company has onboarded its equipment. So it's gotten a very good price for the aircraft that it's brought on. And as a consequence, when it eventually sells those planes, it has a bigger opportunity to sell them at a profit versus its competitors.
Interesting. Let's talk a little bit more about the size here and scale and what that does for it. It's my understanding it's actually the biggest customer of Boeing and Airbus, which was a surprise to me because you and I talk all the time about the individual airlines buying their own aircraft, but this company buys even more. Why is that an advantage?
Absolutely. Today, for example, you have production problems with Boeing and Airbus, for example, and there is significant demand for leased planes. Because the latter OEMs just don't have the throughput right now. So if you look at how this has evolved over the last 20 years, bigger is better in this case. 20 years ago, looking at the global fleet, 30% of that global fleet was leased. Today, it's closer to 50-50. And with the production problems at Boeing and Airbus, I think it's conceivable that the aircraft lessors could even gain a few points. So when we look at that picture, given the very low delivery rates from the OEMs.
The OEMs being the maker of aircraft.
Yes, exactly. So Boeing and Airbus primarily. And if you look at those delivery rates being lower than they should be on a sort of long-term demand trend, the airlines really don't have any other place to turn to get their aircraft. So why is being bigger better? Because in AerCap's case, for example, if it decides to at least modestly reduce its scale and generate cash, it can comfortably do that. They're more than triple the size of the next biggest competitor.
Wow.
So they can shrink modestly and still be much bigger than anybody else and have a very strong global footprint, which I would argue helps them in terms of setting their prices.
Right. And let's talk about capital deployment opportunities as well here. How are you thinking about that for this company?
This is an interesting one. So the company has been very good in terms of its operating cash flow generation. You had an issue with all of the global aircraft lessors. When the war started in Eastern Europe, a lot of these companies had their planes stuck and they couldn't reclaim their equipment. As a consequence of all of this, you have insurance settlements coming through. So AerCap did get over $1 billion worth of cash last year as the insurance came through. Why was that not as interesting as what we could see next year? The reason for that is GECAS, when they acquired GECAS using shares, and GECAS as the entity was offloading its AerCap shares. So the company would take advantage of the insurance proceeds. GECAS would sell shares, and AerCap would use the insurance proceeds to do share purchases. GECAS is done. Now when we think about how they're going to deploy that capital going forward, the company just declared its first ever quarterly dividend. There are possibly some M&A bolt-on type opportunities out there. Will they repurchase more shares? I think that's possible. Will they up the dividend? So there's more insurance cash that should be coming in over the next several quarters.
Gotcha.
And no more GCAS sales.
All right, we got to get first to the biggest risk here, and then we got to get to the stock you're avoiding too. So let's get to it. Multiple large customers could adjust their lease contracts. Who are their biggest customers, and what would be the risk here?
So they are pretty diversified in terms of their customer base. Think of the largest global airlines as some of their key customers. If we were to get into a situation, for example, where there was some deep economic calamity, an aviation type economic calamity like COVID, for example, where these various customers approached AerCap to readjust their lease rates, or maybe go to some sort of power by the hour agreement that could reduce the amount of lease revenue the company receives. And in an extreme case, you always have to worry about defaults. So I don't think that is a big risk. That looks and smells more like a tail risk, but it is something that we thought we would call out.
People should be aware of. Okay, and then let's get to another company within the same space. It's called Air Lease. This is the one you think folks should avoid. This stock has been much more tepid over the past year, up about 9%. It's much smaller than the other company, and you say its lease rates are more volatile. Why?
Yes, absolutely. So, Air Lease has a little bit more than 500 aircraft in its fleet. In terms of its accounting policy, Air Lease will actually not smooth out the additional lease revenue that it receives when customers return planes. So why is that important? The customer is responsible for the airlines, the aircraft operating certificate, and they're responsible for the maintenance. So when they return a plane to the lessor, they're responsible for some heavy maintenance, which gets recorded as incremental lease revenue. What AirCap and several of the other competitors do is they will give you this incremental lease revenue smoothed out. Air Lease has tended to lump it in, so you'll actually see somewhat more volatility in its average implied lease rates than you will with its competitors.
Gotcha. And then there's another way that it is different from its peers, and that's in terms of its cash flow from operations as a percentage of net debt.
Yeah, absolutely. So it's funny, when I started to look at this space, I had to take off my industrials hat and put on my specialty finance hat.
Yes.
So these companies are sort of like banks. They're basically growing their balance sheet to help them lease more planes, and basic spread business. They want to have a lease rate that exceeds their after-tax cost of debt. What you've seen with Air Lease, and I think this is at least partially related to them acquiring planes organically and not doing any M&A, the price point at which they've acquired their equipment has not been as attractive a proposition for them. So when we think about cash flow from operations to net debt on an annual basis, Air Lease is, on our numbers, running some 300 some odd basis points below AerCap.
And then finally, as well, maybe because of this, how do you make the price to book comparison with some of its rivals?
I think it's hard, and I think the street's kind of divided on whether to look at price to book or PE or some other parameter. I would argue price to book is a little bit tougher to use in the company's instances, AerCap versus Air Lease. And part of the issue is AerCap has actually done a lot of acquisitions. It's used its shares as currency, for example, when it acquired GCAS. Air Lease has not done any acquisitions like that. So when we think about book value, I think the street has to make a lot of adjustments on each side of the fence in order for them to be comparable. My personal view is there's just too much noise in doing that, and a forward-adjusted PE is a simpler way to explain valuation to investors.
Gotcha. And then finally, what could go right here? I guess they could change some of their strategies, right? Yep. For example, start to make some acquisitions.
Definitely. They are the third largest global aircraft lessor, so by no means are they small. They are also a very large company. I think there could be opportunistic acquisitions for them if they chose to go that way, which at this juncture it doesn't seem that they will. This strategy has been very good for AerCap. In terms of the spreads, there's a lag effect in aircraft lease rates. So the lease revenue we see today are contracts that were signed a couple of years ago in some instances at the height of COVID. And it looks like when you look at the spread compression for Air Lease, that they were ostensibly a little bit more aggressive in signing some pandemic era leases relative to AirCap, where we do not see the spread compression that we've seen with Air Lease. But certainly from a negotiating perspective, it's conceivable that Air Lease's lease revenue could start to accelerate as the more attractive lease contracts start to spool up.
All right, we'll be watching that as well. Thanks so much, Steve. Good to see you. Buy AirCap, avoid Air Lease. Appreciate it, and appreciate you watching. Goodbye or goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.